listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy Byrne.
Hey everybody, welcome back to another episode of the Daily Gold Podcast. And with us today is Jeffrey Christian. It's actually the first time that we have interviewed him. If you don't know who he is the founder and managing partner of CPM Group, a very respected company in the precious metals world. And Jeff, as we get started here, for those in my audience who may not know who you are in CPM Group, why don't you give us just a very quick intro?
Okay. I've been studying commodity markets since the 70s. I was running the J. Aaron Research Department. Aaron had a fundamental research department in precious metals and other commodities. We merged into Goldman Sachs in 1981. I became the head of Goldman Sachs' Commodities Research Group. I bought out my department and set up CPM Group in 1986. So since 1986, we've been an independent commodities research and consulting company focusing on precious metals, specialty metals, and then across all commodities. So we do energy and agricultural and other aspects of commodities too. Coming out of Wall Street, we have a lot of financial background and we have a financial orientation. So we know a lot about how commodities, especially gold and silver, are traded and how they're hypothecated. We know a lot about option strategies. In my 34 years as being independent at CPM Group, as well as my time prior to that, we've done a lot of advisory work with central banks, major mining companies, major industrial users, governments, and a lot of institutional investors. So we have a lot of background and insights as to how these markets actually work.
Okay, very good. Well, with that said, you're the right person to talk to on this. Of course, nobody can predict the future, but you probably better than most when it comes to precious metals. Jeff, I mean, I've heard bits and pieces of various interviews you've done recently, but for me and my audience, maybe you could talk about your expectations for precious metals prices over the next couple years or 3 or 4 years, and what do you see happening, and maybe why you think that way.
Okay. Yeah, let's start with gold because each one's a little bit different. Gold and silver are somewhat similar, but let's start with gold. And the first thing is we keep telling people, don't expect the world to collapse. That's actually not how the world works. We have these periods of global financial crises and deep or shallow recessions, but we usually paper them over. And that's happened for the last, 500 years or so, and it's probably going to continue. Now, that said, we see significant increased risks in the world, financial, economic, and political. And they're getting bigger and they're getting more problematic. Our expectation is that they don't cause a major financial crisis initially. For the last couple of years, we've heard a lot of people in the financial markets talking about the imminent start of a recession. And our view has been, well, we might have a shallow recession, but probably not. We're expecting a bigger recession, but we're not expecting it until later. So our view is that 2023, 2025 is a period where maybe some of these problems come home to roost and actually cause problems. Now, in that environment, if you look at gold, 2018 and 2019 saw the lowest levels of physical demand for gold by investors since 2001. And it was reflected in the price in the first 18 months of that 2-year period. The gold price fell and it was flat. But in the second half of 2019, we saw the gold price start to rise. And if you look at the market, that increase was almost entirely stimulated by short-term momentum-type traders, primarily in the futures, forwards, and options markets. There's a little bit of buying in the ETFs, but physical investment demand was extremely low even in the second half of last year. central banks were bargain hunters, and they came in with those low prices and bought. And then as 2019 continued, and even though the price rose, the price rose from June to September, and then it fell back, and central banks took the opportunity of that decline to buy more. So our view going forward is that we think gold prices continue to rise. The world financial system isn't collapsing. We probably are heading toward a deep recession, but it may be later, and it may be papered over. And in that environment, we think gold prices, head towards 1,600 and trade between, say, 1,580 and 1,680 for the next year or two. But then by 2023, 2025, we think that you see a resurgence of physical demand for gold from investors because of economic and political problems actually becoming much more problematic than they have been. And in that environment, we expect gold prices to rise to record levels, higher than they were in 1980 in real terms, and higher than they were in real and nominal terms in 2011. Silver's somewhat similar, but we don't have the price rising quite so strongly because we think that most of the investment demand will focus on gold, which is the historical and traditional pattern that you see. And then platinum and palladium are very interesting because we think there's going to be a reversal of fortunes. You've had a situation over the last 4 or 5 years where palladium has been very strong. Fabrication demand has been maybe growing at 3 times the level of platinum fabrication demand. Inventory holders and investors have not been selling because the price is rising. They want to see how high it goes first before they sell. While platinum prices fell 2012 to 2015 and have moved sideways for most of that period of time. Going forward, we think that you'll see platinum dust itself off and start rising again. And palladium, we don't see it falling sharply, but we don't see it continuing to rise at such record levels. And we think you'll see some substitution away from palladium back into platinum by fabricators. And you'll see tighter platinum supplies and relatively more ample inventory sales by investors holding inventories.
Okay, I want to go back to just a quick follow-up on your gold price targets because
Sure.
you didn't mention anything nominally, but you did say in real terms, and for those who are familiar, if you're predicting a new all-time high in real terms, relative to the 1981, in terms of the CPI, I could be wrong because I haven't looked at that in a while, but I have to think that's well past $2,000 an ounce. I don't want to pigeon you down on a exact number, but so with what you're sensing could come in the next 3 or 4 years, so you're looking for a gold price that's going to clear 1,900, probably go well above it. Is that fair to say? Maybe you can expand upon that.
I can give you exact numbers. On a nominal basis, and think about we project 10 years out or longer in annual average terms. So let's talk in annual average terms. In 1980, the price of gold got to $850 on an intraday basis, but the average price was like $612. In 2011, 2012, the price got to something like $1890 on an intraday basis, nominally. But the average annual price in 2011, 2012 was just slightly over $1,600. In our projections going forward, we have nominal prices probably approaching $2,100 on an annual average basis, right? So on an intraday basis, we have it going higher, but that's in a spike that comes down. And on an annual average basis, we have it around $2,000, $2,100 in nominal terms. In real inflation-adjusted terms, we have it around $1,800, $1,900 on an annual average basis, 23, 24, 25.
So what does that mean for silver? Does that mean, when you throw those figures out, I'm thinking, $50 an ounce could be a reasonable target for silver nominally. That's big resistance, the 1980 and 2011 highs. Where does silver fall in there?
I don't have my long-term silver projections right in front of me, but we are looking at it, closer to $30 than $50. And again, annual average basis. If you look at the silver price in 2011, yes, it touched $49.90 or whatever it was at the end of April of 2011, but the annual average price was closer to about $35 an ounce. And I don't think that we have it rising past that in our projections going forward, but we do have it rising significantly from where it is today.
Now, I don't want to look too far off in the future, but suffice to say, those would, at least in your view, mark some kind of a top for the market. But, I mean, I have to think if silver rallied up and peaked again at that level at some point in the future, it would probably clear $50 an ounce, and then it would, perhaps head into another bubble or mania. Is that? I mean, I don't want you to look past 3 or 4 years because
we go out, as I said, we go out 10 years, and with gold and silver, we have the prices rising sharply, 23, 24, 25, and then we have them coming off. So we don't, and then we don't have them coming down to where they were, prior to 2008, 2009, but we do have them coming off. And that's the nature of these markets. There are people who keep thinking, the price of gold is going to go to some outrageous number or even a reasonable number like $2,000 and stay there. But the reality is that these are financial assets and they are commodities. And, you have 2 billion ounces, 3 billion ounces of gold in bullion form that can come back to the market if the price rises, at least some of it. So what you look, if you look at it, I started in this business, as I said, in the 1970s. And when in 1979, or beginning of 79, I started focusing seriously on gold and silver. I had been looking at energy markets and copper prior to that. And in early 79, people thought gold was dead at $190 and silver was dead at like $3 an ounce. And then, gold went to $8.50 and silver went to $50. And my view was these things are going to come back off because we had, 21% interest rates, 14% inflation, U.S. hostages in Iran, Soviet troops in Afghanistan, a quadrupling of oil prices. That was the economic and political environment that drove prices higher, and you could see that as that changed, these prices would come up. But there were a lot of people who thought, no, the prices go up there and stay. And I was shocked that they thought that, and then we entered a 20-year bear market. Then the price started rising again, and they got very high. And there were people saying, they're going 4 times higher than they actually went, and they're going to stay there. And that's not how markets work. That's a rigged market if a price goes up and stays, And you saw that, you're seeing it in the stock market now. You saw it in the oil market from 2002 to 2011, where you have a managed price that doesn't have a give and a take. It rises in a steady fashion and it doesn't fall. And that's not what you see in the precious metals markets. It's not what you've seen throughout the history of precious metals markets, and it's probably not what you should expect in the future because the history suggests that's probably a bad expectation.
So, but it doesn't sound to me like you're expecting some kind of a 1980 type peak in precious metals, or maybe you are. Correct me if I'm wrong.
We're expecting precious metals prices to go higher than they were in 1980.
But I mean, in the next, with your targets, let's just say 2024, are you expecting a peak like 1980 or 2011 or 2008? What kind of? I know it's hard to look that far in the future, but I'm just trying to get a sense of what you think is coming in the next decade.
People pay us to look that far in the future, and our view is that we'll see a peak similar to what we saw in 2011, 2012 in both silver and gold.
Okay, now let's zoom into from there all the way back to the short term. Gold, I don't know where it closed today, but it's basically around a high, but that's not being confirmed by silver or the gold stocks, at least not yet. Does that concern you in the short term for this year? Or, I mean, are you thinking about that? Or what else are you thinking about as far as this year in precious metals?
We're looking for the price to move towards 1,600 by the fourth quarter of this year, and then sort of plateau around there. And partly it's, where it goes from there depends on what happens with the election, and what happens with the Senate after that, and what happens in the United Kingdom now that it's leaving Brexit today as we talk, and what happens in the rest of Europe. And then there's China and India and Russia. I mean, there are a lot of political issues out there. But our view is that the price gets up to around 1,600 on a quarterly average basis by the end of this year.
That would still be very significant, holding around that level, as you say. Jeff, then what does that mean for silver and the gold stocks? Because they, as you know, they've lagged even in the in recent years. They haven't had the big breakout yet that gold had last year. So do you think those markets could catch up a little bit if gold's going to hold around 1,600?
Again, it goes back to a point that I had made and another point I will make. I think that you'll see gold outperform silver both this year and in the longer run. This year, I mean, gold outperformed silver last year. We think that silver will play some catch up this year. I think I can't remember what we're looking at in terms of annual price increase in silver, but it's roughly equivalent to the annual price increase that we're projecting for gold for 2022. So I think that silver will play a little bit of catch up, but there are two big issues to talk about, both with and it relates to silver, gold, and gold equities, and they both do. One is that you're not seeing this in physical investment demand, and studying the market over the last 40 years, what we've seen is it's physical investment demand that really drives the gold price and the silver price. And we had extremely low physical demand for gold and silver last year and the year before. There are a lot of investors who have been turned off and they're not coming back. There are more of them coming back to gold than silver. And there are more of them coming back to gold than gold equities, because gold equities suffer not only from a disappointing bullion price in the minds of some investors, but they also suffer from underperformance as corporations, that have not lived up to their promises. So one of the things that you're seeing is this absence of physical demand. Now that's important because you are seeing gold and silver prices rise. Silver is not that great. It's $18 as we speak on Friday afternoon, but that's up from $14, $15 a year 2 years ago. So that's still pretty strong. And gold is obviously up from $1,280 to around $1,590 today, 31st of January. So you're seeing the prices start to rise over the last 6 months in an absence of investment demand. When that says to us that if and when investors come back saying, I want physical metal because I'm concerned about the stability of the financial system or my local bank or my local government, that the prices will rise sharply. So that's one of the factors to think about going forward. But the other, and that weighs heavily toward gold, less heavily toward silver, and least heavily or negatively toward the mining shares. Because in that kind of environment, you don't care about future production. You want physical gold and silver in your possession. The other factor, which we've done a lot of work on over the last few years, are these major transformations that are occurring in the global financial system. And it's not just gold and silver, and it's not just gold mining shares or mining shares. There are major changes in the interest rate markets. There are major changes in the way investors trade precious metals and other commodities, moving away from fundamentals and macroeconomics and moving more and more toward momentum trading and chart-based trading and computer-generated buy and sell signals. And you're seeing the same thing in the equity market. So you have a lot of money moving away from investing in individual shares, and instead they're investing in ETFs, gold mining ETFs, NYSE indexed ETFs, TSX listed ETFs. So what you've seen in the last 6 months is as the gold and silver prices rose, those mining companies whose shares, whose market cap were large enough to be in these indices, their share price did well because you had these computer-generated purchases going into indexed funds and ETFs, and those companies that were too small to be in the indices didn't do so well. And you have, for example, a year ago when Barrick made its run for Newmont, we looked at BlackRock. BlackRock had 65 funds that it was managing that owned Barrick shares. 5 of them were managed by humans in conventional portfolios, and the other 60 were indexed funds. And the index funds obviously had quite a bit more Barrick shares than the personally humanly managed funds. And that's a transition that's occurring across financial markets and across equity markets. It's not limited to the mining industry, but what it's doing is it's starving smaller companies for capital, and it's driving them into private equity.
Okay, that's very telling. So going back to, let's say, silver and the gold mining companies a little bit, aside from the gold price going a lot higher, what has to happen to get more interest and speculation in those markets?
Well, several things. It's funny because we did just do a study, and we'll be talking about it in a couple presentations up at the PDAC in early March. And we've come up with a variety of prescriptions. But I think that the mining industry needs to mature. And you find, well, what we found when we started talking to institutional fund managers who still actually pay attention to the markets and individual companies, is they're kind of turned off by the lack of actual performance, corporate performance as opposed to share price performance. They don't like the share price performance, and they don't like the performance for them as shareholders. But they're also not particularly happy with the operational performance of a lot of mining companies. And they find that this industry is, in the minds, or to use the words of some of the people we interviewed, they're overly promoted. And it's interesting because the institutional shareholders probably need to understand better the risks inherent in mining, but so do the mining managers. Mining as an industry has a different risk profile than oil and gas and other companies and other industries. And you saw, like when I started in this business in the 70s, you had a number of oil companies getting into mining. And almost universally, it was a disastrous event for them because they didn't understand mining. And when you're an oil and gas company and you're drilling an exploration hole and you hit oil and gas, you've just spent the bulk of your capital. But if you're a mining company and you do your exploration drill holes and you hit ore, you're just beginning your capital expenditures. You have this extended long period of time where you need to spend a lot of money exploring that deposit, delineating it, generating models of the ore body, and determining what's the optimal mining design and rate, and a lot of other issues. And what we find is a lot of investors don't understand the risks inherent in mining, and then they get disappointed. And so I think that there needs to be education for the management of the mining companies, but also for the investors. And I would love to see more educational seminars and fewer promotional seminars for the mining industry. And I think that a lot of investors would probably appreciate that too.
Right. Yeah. Very well said. Now, Jeff, before I let you go, can you please tell our audience how they can follow you and your work?
Oh, gosh. Probably the best way, I mean, we have a website, cpmgroup.com, and that's the best place to go. There are some free reads there that if you go into our market views, you can sort of download articles and interviews and speeches and things that we've done. And then you can also find in another place, I think it's called our products, our reports. We produce annual gold, silver, platinum yearbooks. They're $160 and they're ebooks. So you buy them and you get them immediately. They come out, gold comes out in March, silver comes out in April, and platinum yearbook will come out in June. And those are really good primers. And then after you've read that 200-page book, then you can delve into other things in more detail.
Okay, Jeff, well, it sounds like almost perfect timing to get those yearbooks. They'll be coming out soon. Thanks so much for coming on. I really appreciate it. I hope we can do this again. And also, I know you travel a lot, so be safe when you're traveling to PDAC. Don't catch that coronavirus.
Well, yeah, in 2018, I spent 6 weeks in China. And then the trade war got really nasty. And last year, I only spent 3 weeks. And in December, my Chinese partners were telling me that I would be spending at least 5 weeks in China this year. But last night, the State Department said, you may not spend any time in China. So thank goodness for Skype. Yeah.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to thedailygold.com. And for premium coverage of precious metals and the best junior mining companies, visit thedailygold.com/premium.